if you understand how to utilize options, you can cash flow your gold and silver. So you don't need to own it in physical form. You can own the ETFs and then do some of the strategies that we do where you actually still own the hedge, but you can create cash flow off of it.
Welcome to the Cashflow Academy podcast. This is where we do our very best to make investing simple. And I'm Andy Tanner, your host. I'm joined here by Corey Halliday and Noah Davidson. How we doing, guys?
Excited to be here.
Absolutely.
Okay, fantastic. Today, interesting topic. We don't talk about this much because most of our time is spent in assets like stocks, assets like options, derivatives, stuff like that. And today we're going to talk about gold. And we'll tell a little story about gold. But the thing that brought this to our attention is just really a technical move as far as the chart goes. And so, Corey, we had a little conversation about this last night. So you want to talk a little bit about that?
Yeah. So gold is kind of an interesting long-term setup where it's really vastly underperformed the S&P 500 for the past decade plus. And what that's done is created a big sideways base. And so think about it from the standpoint of building a skyscraper. You need a big foundation underneath, which could be what's happening with gold. Is there could be this big solid sideways pattern underneath. And technically it was hard for gold to get through 1,000 an ounce for a long time. Kept bumping its head against it and would fail, and bump its head against it and would fail. And then when it finally broke through, it was off to the races, and that old ceiling became the new floor. And what it seems to be happening now is 2,000 is kind of a hard hurdle to get through, and it's bumped its head kind of up against that and struggling. And once we clear that zone, that old resistance can become the new floor.
Now we'll we've had the podcast on places like iTunes and iHeartRadio and other places for about 5 years, and so we'd invite you guys also to check us out on YouTube as well, because we're going to add some visuals. So I'll do my best for those that like to listen to audio to describe what we'll be seeing. But I thought it'd be fun to look at that chart. Before we do, Noah, what's your take on gold right now?
Well, it's a pretty shiny object. People tend to like it. And it seems to be wildly popular. It's a value store. I think gold is a value store. It's a hedge against inflation. It's a hedge against other risk elsewhere. I think a lot of people out there, like last week, we were talking about, the credit rating being dropped and maybe bonds not being as secure as we all believe, we want them to be. So if there's, people have some doubts out there tends to be a what do we call it? A flight to safety, and gold is an asset that'll hold its value over time.
That seems to be the case. It's interesting. I always I like to play devil's advocate a lot. The older I get, the more I like doing that. I don't know if that just means I'm an old codger now, or if I'm just unagreeable. But Steve Jobs gave a commencement address at Stanford, which the irony of that was thick.
Yeah. Anti-education, essentially.
Yeah, he basically, his actions spoke louder than his words anyway. Right. So you drop out of the school, become wildly successful because of that decision, and they invite you back to talk to the people that stayed in. Right? But in that, I have a big quote on my wall. I think it has affected me as much as anything I've heard in my life. And when he said it, it struck me. He said, "Don't be trapped by dogma. Don't be trapped, with living with the results of other people's thoughts and opinions and what they think." And so, whenever I hear someone just declare something that's not qualified, just unequivocally declare, gold is money, then I like to say, okay, well, is that true or is that just dogmatic? And I think, okay. Well, there was a time where maybe a beaver pelt was money, or some other Jim Bridger,
some seashells or something.
Some trapper or seashells. And there's time where feathers, burning the tally sticks, we don't use those anymore. There was a day where feathers were no longer considered money, or or whatever. So in 1971, there's some people that say, and I'm mostly in this group, that say, you know, the dollar is no longer money because it's no longer backed by gold. So the dollar is no longer money because gold is money. But if you look at, you know, a store value, a medium exchange, all the, you know, fungibility, all that stuff, when I go to the grocery store, I see more people using dollars through their credit card than gold. And so there could be an argument that says, you know what, gold isn't money anymore. It's a credit on a ledger.
Yeah.
By decree. I mean, look, just because it's by decree, it's fiat currency. So it is an interesting time to think about, you know, is gold no longer money? It has value in, like, for example, this little 10-ounce bar of gold right here. And I was like when the first thing you do is when you hand it to someone, they rock it to sleep because it's so much heavier than you would imagine.
Hold on, I want to drop it on the table.
Oh yeah, bam! There you go. Oh. So yeah, boom, echo. But it's interesting because this doesn't do anything. It sits in a safe, and it sits there.
And that's one of the arguments against gold is that it doesn't income. There's no cash flow. And so when interest rates go up, that tends to be bad for gold. And we've seen interest rates go up, yet gold is kind of hanging in there, which is an interesting dynamic. Typically, that they're competing against each other. People would say, well, if interest rates are very low, I'm not losing anything being in gold because I'm not missing any real income. But now that interest rates have gone up and you can collect 5% on your money, you can put it in short-term treasuries at 5%, but gold is going to pay you nothing. That's a competition. And so I think that speaks to one of the negatives for gold. Like you talked about, you need to know where your position is vulnerable. You need to know what could work against your position, but also you can look at the relative strength. And there's a little trader adage that when something has bad news or something should be knocking it down, but it holds up well, that's powerful. Or the vice versa. When there's really good news and something's acting horribly, there's something more to the story.
Your comment's on track because the comment you made was about people.
Yeah.
You're looking at what other people think about it, right?
Yep.
And to me, if you compare this to other, you know, elements or rocks, well, it's scarce, and you know, maybe it doesn't tarnish, you know, stuff like that.
It is scarce unless we figure out how to get all that gold that's floating around throughout the galaxy.
Yeah,
we'll figure out how to get that down here.
That asteroid full of gold, but you know, the scarcity is one thing. But here's the deal: you're on a desert island, and you've staked a claim on a coconut tree, and you're big and strong enough to defend it. And you've got some gold that you had in your pocket. Eventually, that gold's going to wind up, if you even wanted it.
To the person that...
If you even wanted it. Like, you would gladly give it up for a coconut at some point when you're starving. So it's all about scarcity and what you really need. If you don't have food, you'd much rather have food than gold. So it's about scarcity. But even more so, it's about people and their confidence. So if I'm going to sit here and, you know, play the devil's advocate on gold, it's like Robert Kiyosaki says, you know, there's three sides to every coin: heads, tails, and the edge. Intelligence is found at the edge where you look at both sides, right?
Yep.
So I look at that and I say, how much gold do I want? Now, some people say you can't have too much gold. I disagree. I think you can, because when you look at a financial statement, you really have, you know, maybe three things you might want to tweak it with. You say, well, I want to put an asset in there that'll cash flow, and you know, that's the golden goose. Or I want a capital gain. The gold will change, the egg will change in value.
Yep.
Or the goose will change in value. I want to buy low and sell those items high. Or you have the hedge, where you say, well, I look out there at people and I say, if people don't like this, will they like this over here? And try to keep a balance and some preservation to the wealth, like you mentioned, the store of wealth. So why would I have this? You know, it's done absolutely nothing for me for years and years and years. Absolutely nothing. You know, like you said, it's been a sideways movement. It hasn't produced cash flow. I haven't used it. So why do I have, you know, some of this stuff? Well, I think it's a hedge against what might happen to the dollar. And I think there's enough people out there who still believe in it. But if the number of people who believe in it gets really small, then it's all based on confidence. Yeah. There's not I've heard, I love this quote Robert said one time. He said, well, a dollar is government money, gold is God's money, and Bitcoin's the people's money, right? I mean, interesting perspective. So with that said, and that little discussion on gold, we saw a chart. And Corey described a little bit, and it's basically what we call a cup and handle pattern. And Mr. Ken Slim, in honor of the late William O'Neill, didn't you say he?
Yeah, William O'Neill.
William O'Neill's the
he popularized the cup and handle pattern for sure.
He's the guy, and that's one of the major patterns that are there. And all it really says is, cup and handle pattern basically says this: stock fell down and people started buying it, or the commodity, or the gold, or the gas, the oil, whatever we're talking about, fell down to a low and went back up to its previous high. And when it started to fall back down again, it didn't get down before people started saying, hey, this is a bargain. And so it does give us some insight into how people feel about it, that change in perception, that idea that, hey, we're going to buy it before it gets that low. We can't sit on the sidelines. That's a support line.
It's a clear indication of demand at a higher price.
For sure.
Because it tests a threshold price. Yeah. And, it comes down off of that. And when people step up and buy it closer to that threshold, it's usually an indication that they believe it's going to break through the threshold.
It's a trend.
Yeah.
There's this trend towards saying, hey, this is valuable. So we have a chart.
Yeah, let's check it out on the board.
Yeah, we'll see if we can use this technology here, this whiteboard, and let's bring that up.
So here's the long-term chart of GLD, and I hope you can see it and still hear me, but you can see the highs that were set back here, and this is 2011. So this is a long time ago. We're talking 12 years ago that the high was put in gold previously. And from 2011, it really got hit dramatically, and that's that drop that you talked about. It finally bottomed out in about 2015, 2016 time period. So we're good. So 2015 was the bottom. Then it recovered, and about 2020, we came back up towards those highs. In 2020, it's interesting. That was, of course, COVID. And we talk about correlations, uncorrelated pairs, where you talked about the S&P 500 being uncorrelated to gold. One of the reasons you want it is as a hedge. If they don't like stocks, they might like gold instead. And so notice 2020, it shot up dramatically when the world really was derailed and the economy was crushed and so forth. And that was the initial retest. And then that rally ultimately failed, and we fell back again. And each of these lows has started to become a little bit higher and a little bit higher here. And we've kept testing just right around that 2,000 an ounce-ish area for gold. So we're kind of setting up as that big cup and handle. So for those of you that are just listening and not watching, you just picture this big bowl and then this little handle, like your mug. Yeah,
it's like the teacup ride at Disneyland.
The teacup with the little handle on the top. Exactly.
Yeah, so we have it flirts with 2,000. It drifts back down to 1,000. It goes back up and hits its head on 2,000, and it's looks like it could be looking to test that 2,000 once again. And as Corey said, if it breaks 2,000, that's a big psychological barrier. Tell us a little bit about those round numbers, Noel?
Well, big fat numbers are just one. I think it's just simple lazy thinking. It's easy to look at a big number and say, oh, that's a high price. 2,000, big fat round number. And, you get to this point where, well, are people willing to pay more than that? Thus far, the answer has been no. It's gotten up to that $2,000 threshold, and supplies come in. People are willing to sell it at that price, but they haven't been willing to pay more than that price as of yet. And what happens is you get what's called polarity of price. When it broke the $1,000 threshold, prior to that, the belief was, well, it's not worth more than 1,000. But once people decided they were willing to start paying more than that 1,000, the perspective switches. Well, if it's worth more than 1,000, then it's clearly not worth less than 1,000. So now here we are at that kind of near that 2,000 threshold. It's like 1,760 some odd bucks right now, which again, people are willing to buy it at that price. There's been lots and lots and lots of transactions in that range. Eventually what will happen is if there's enough demand, you will see people willing to pay more. Now, I saw an article recently, and this may be a little off topic, but India made its first big transaction in oil using something other than the U.S. dollar. They used the BRICS currency, and that was a headline I read this week.
Yeah.
Now, demand for the dollar is something that has been, kind of universal. Dollarization of economies around the world is really, really common. Like in Argentina right now, they've lost confidence in their paper currency. They've had over 100% inflation.
Yeah.
And you've got a political candidate running on a platform of dollarization. We're going to use the greenback, the U.S. dollar. And that's, again, a confidence thing. So one thing I think that could help push gold up over that $2,000, threshold is the confidence or lack thereof in a diluted currency.
And that brings us to, it seems like we always circle around to monetary policy at some point where, and it's tied to fiscal policy, is the threat for, David Walker is one of my heroes, and David Walker is a former, I should get him on the podcast. I should see if he would come. David Walker worked for many years as a Comptroller General of the United States, nation's lead accountant, head of the Government Accountability Office. And he worked under Democrat and Republican administrations, several. He was a veteran. He quit his job in frustration because no one was listening to him. And he said, he gave an interview probably to 60 Minutes or something, and I'll probably butcher the quote. I'll do my best, Mr. Walker. But he said, the greatest threat to our nation is not someone hiding in a cave in Afghanistan, referencing, bin Laden, I would imagine. He said, the greatest threat to America is its own fiscal irresponsibility. I think that's pretty close to the quote. And he said there's nothing more dire. And I think we've actually gone past the point of no return. I mean, there's a certain place on, you're going down Niagara Falls and you just, it's like when you jump out of the airplane, you're not getting back in, right? You're at a point. Now, whether you land, whether your chute opens or not, who knows, but you are not going back. I think we're at a point of no return with that. So, a political candidate that says save dollars, they're going to lose value. Maybe he's saying, look, better that than the volatility we've had. Yeah. It's a less aggressive devil.
Well, interestingly enough, like that inflation, which is something that in the U.S. we have not truly experienced.
No, not like
they have down in South and Central America and other places in the world. In fact, this is kind of one of the things I learned from my friends from south of the border is that one of the reasons they wear gold chains is kind of a common stereotype of a machismo, sexy hairy chest with a gold chain right there, is they use that for barter. They use a link off. It shows their wealth, but it also, they can use that because when you go through 100% inflation, 1,000% inflation, they have a little saying in Spanish that says, say, cuenta sus gallinas, count your hens because they can lay eggs and that's how you eat. And when your money doesn't buy, food anymore, or the amount of money, like if you don't go take your paycheck and go spend it right away, that same concept you're talking about with the coconut before.
Well, and when you're trying to get rid of money, then prices get bigger.
Yep.
Because you want the stuff, you want the coconut rather than this gold bar.
Right.
Right. Yeah. In that case, so I'm a big fan of gold. My grandfather was a gold bug. He's the one that taught me about gold when I was 3 or 4 years old. He had a makeshift smelter at our house, and OSHA would have freaked out. I mean, that explains a lot of the problems I have. It's like, we had lots of chemicals and mercury and every kind of acid, and he dumped that stuff out in the tailing pond, and there was the garden about 50 feet away. So that tells you where we were.
The original Breaking Bad.
It'd be scared to take a Geiger counter just where that house used to be, and all the employees are lighting up now. That work in the office buildings there now. Corey, let's talk about now the history of gold. There was a time, particularly in the Bernanke era, the end of the Greenspan era, the Bernanke era, where we had the subprime meltdown. Banks, financial institutions were under tremendous stress, and gold just went through the roof because the policy was so accommodating that everyone said, we're gonna Zimbabwe, we're gonna hyperinflate, we're gonna make Venezuela look like a birthday party, right? And it didn't happen to the degree even close to what they thought. And so we had this huge surge in gold and silver. Even silver was like $48 an ounce.
Yeah.
And that chart right there, the left side of the cup,
that was part of that.
Well, that was part of it, but they changed margin requirements on the derivatives, on the futures, and that caused the price to come down. So they manipulated the price
market.
of it. Yep.
Yeah,
to bring that price down.
Yeah. But let's take a look, Corey, if you would, and let's go back to the whiteboard, and we'll describe it for listeners. That what we're going to do is the gold sellers. I always laugh at the gold sellers, and I have some great friends that if you want to, let me give you some great people to buy gold from. Mike Maloney is where I get some of my gold. Anthem Blanchard, Anthem Vault will store it for you. I mean, there's some great guys that do gold. But I always kid them that they're saying you should buy gold, you should buy gold, you should buy gold. And well, then why are you selling it?
Yeah.
Right?
That's true.
You should buy gold. I mean, and all the time I've known them, they've never been bearish on gold ever one time in any period. They're in the gold business. That said, here I sit with my gold, and I'm happy about it. So here we've got two graphs, and we've got gold versus the S&P. And if you go from about 2013, you've had, it's just even 2010. Let's just go the last 10 years, 2013-ish. Can we get that? I don't know.
Yeah, I should be able to pull this back.
There we go. Right about there. That's perfect little intersection there. So gold is up
just above zero. Up a couple of percent.
Yeah, it really fell after 2013. It really fell in the last 10 years. And then, it's kind of hovered sideways. The S&P's up 300% in 10 years.
Yeah. And
gold's flat in a decade. And that's interesting because a decade in your investing life is a significant amount of compounding time.
Mm-hmm.
Yeah.
Absolutely. 10 years is, if you live to 100, it's 10% of what you got. Most people don't live to 100. Most people don't start investing until they're 30 or 40 anyway, against my advice.
And this chart is very instructive because you have a couple of things there that it teaches. Number one, that they're not correlated, like we talked about earlier.
Yeah.
So that's what a hedge is designed to do. What you want out of your hedges is to say, well, when these aren't working, I want this to be working. If these are working, great. This probably won't be working, but that's the design of a hedge, is to say, if all heck breaks loose, the S&P 500 falls, my 401k falls, whatever it is, where am I making money? And gold and silver can do really well in that environment because that's where they typically flourish. Well, the last 10 years have been great for stocks, not so good for gold. It also is instructive because while gold hasn't made anything, if you understand how to utilize options, you can cash flow your gold and silver. So you don't need to own it in physical form. You can own the ETFs and then do some of the strategies that we do where you actually still own the hedge, but you can create cash flow off of it by selling options.
So you mentioned this saying, count your hens because they lay the eggs.
Yep.
And I'll just ask people right now, and I think this is where Warren Buffett agrees, is if you had the choice, it was an inheritance. You didn't have to buy it. You had a choice to inherit a golden egg or a golden goose that laid golden eggs, which would you want? And everyone would choose the goose. And and this is where I really love to have the conversation with capitalists, because I'm a capitalist. And as a capitalist, you're really going to say, all right, there's consumption that I'm going to do in the world, and there's production that I'm going to do in the world. And I think there's a principle, I think it would be true in all cases, where the producers, they are always going to wind up with the cash from the consumers. I think Warren Buffett wrote a little story called, what was it, Squanderville, and can't remember the other.
I don't know. I'm just gonna make it up though. Sabertown.
Whichever the ville.
Sounds right.
Yeah, and he just showed over time that the country is two countries. One's called Squanderville, and the other was called whatever it was.
Sabertown.
Sabertown is what we're going with.
Whatever it is. But it was production town really, because and it just showed eventually. Even if you do PPP money, and even if you do idle money, and even if you do helicopter money, let's say you do helicopter money.
Yeah.
Well, give it to the consumers, and they'll give it back to the producers, and they'll make those exchanges, and the margins work in favor. And so I really love Buffett's thought of the golden goose. And we'll get into Newmont Mining here in a little bit. We did a newsletter on this, and if you want more details, find the Rich Dad newsletter. But I'll give you a synopsis of it. Maybe you want to sign up for the newsletter. But Corey and we talked about this last night, Noah, where I loved the Barrick Gold play from Buffett. Not necessarily because it's paid off great, because it hasn't. Gold's been flat, and the stock price has been flat. But I love the philosophy of it, because think about it. If you believe in this, like Robert Kiyosaki, I know I think it's public information. Well, it is now. I don't think he'd be upset. And he's always been interested in mining, silver mines, gold. He had a gold mine. He's talked about publicly in China, and I know he has an interest in one just south of Kennecott, kind of where Cedar Valley is in my home state. Very rich gold mines. Because think about it. If I buy this, 10-ounce, this is probably worth what, $1,800 or something or $18,000, something like that. Well, if you went out and you bought stock in a company like Barrick, you own all the gold that could ever be produced and pulled from that thing.
Yep.
Think about the bang for your buck. Here, I know what I'm going to get, but there, if I believe there's gold in the mine, I own all of it is part. I own part of all that. And all that production in the future, which could be, 10 of these, 20 of these,
and miners,
over my life.
And the miners have that leverage, right? So they have leverage over gold prices because of their profit margins. They pretty much have fixed rates in terms of what it's going to cost them to pull gold out of the mine.
Lifting costs in oil.
Say it's $1,300 an ounce. They kind of know, okay, if we pull an ounce of gold out of the ground, it's going to cost us roughly $1,300. Well, if gold prices go up a lot, that's extra profit margin to them. And so they're just the leverage play. Now that cuts both ways, because it's really worked against them when gold prices have been down the last decade plus. But in an environment where gold really starts to take off, that leverage that they have to it would be dramatic in their favor.
Let's find a period. Let's not cherry pick our charts. Let's find a period where gold destroyed the S&P. If you go back further, you have to go back quite a bit. There's a little period from 2006 to about 2012. Yeah.
Well, it really kind of took off after the 2008 financial crisis.
That was Fed policy. Mm-hmm. Everyone thought that we were going to hyperinflate. It was going to be Zimbabwe. It was going to be the Weimar Republic. People were, saying it will not work. We didn't hyperinflate. The irony is now we have had more inflation than I've ever
inflation's
seen.
kind of a lagging phenomenon, is it not?
Well, it seems to be now.
It takes a while for that money to make it into circulation. Even gold has gone through its own actual inflation, deflation throughout history.
Sure.
Like when the Spanish conquistadors came back from the New World with boatloads of gold, the prices of everything in Spain went up because they just had more coins. They had more gold in currency in
They had more
in
to,
circulation.
Yeah.
So yeah, I think the scarcity and the demand and
Look
the
at
confidence
Noah.
in other instruments.
Look at Noah pulling out, Spanish conquistadors.
Well, you know what?
mean,
Well, Copernicus at
in-
that same time kind of had an epiphany. He's the same guy who came up with the heliocentric model of the solar system.
They threw Galileo in jail
Yeah.
because he was listening.
Well,
to
he
Copernicus.
said, you know what? It's not the amount
House
of gold in the
arrest.
coin. It's the number of coins in circulation.
Yeah.
He says the value of a coin is really based on its scarcity.
Yeah.
Yep.
And that was kind of an aha moment. The same as like realizing, the sun isn't going around the earth. It's the other way around. It's just interesting. Like I've spent a lot of time studying the history of money because I wanted to understand money,
Right.
monetary policy better. And there's other things at play. There's a guy named Sir Gresham who came up with this thing called Gresham's Law, which is that people hoard the good currency. They keep it. They'll bury gold in the ground, and they'll spend the currency that they want to get rid of for goods. And so that's one of the reasons that when a currency starts to devalue, people try to get rid of it,
Yeah.
and they'll spend it into oblivion. So.
Well, they want to get out of the currency and into things that won't lose the value.
Yeah.
And that is assets, anything, right? Buy homes, buy stocks, buy something that produces versus something that's constantly losing. Because think about the US dollar's value. If you pulled up a chart of the US dollar, it's always in a downtrend because it's always buying less. As they continue to print more and more of it, it buys fewer goods and services. So it's essentially almost guaranteed that the US dollar is going to buy less 20 years from now, 40 years from now, 60 years from now than it does today.
I love the way Buffett thinks about this
Yeah.
because he looks at production. And, it's not food, clothing, and shelter anymore. I mean, I love real estate. We own, you and I own some Kraft Heinz together. I own a ton more shares, in my own personal stuff. But it's not just food, clothing, and shelter. It's medicine.
Yeah.
It's energy. It's technology. You can't live without a cell phone. You can't live without oil.
Yeah.
You can't live without technology and all of this stuff. So to be on the side of producing all that is a huge deal. So back to the Barrick Gold play. I really liked Buffett's. I don't know what he was thinking on it, but I was grateful to watch that trade because it got me thinking about it. I thought I would rather be producing gold because then it's like a farmer. If all of a sudden the price of wheat goes up and my labor's the same and my pesticides the same and my fertilizer's the same, my gosh, your profit margins soar when your overhead is relatively stable.
Yeah.
And so I thought, if you really believe that the dollar will have at worst a demise and at best a serious devaluation, then why wouldn't you want to own the mine? So that brings us to, I'm not going to go into the specific trades because it's too hard to do on a podcast. It's more of a class, or we do it in the newsletter where we have a couple of trades. But it would be, I'm just saying, boy, maybe you buy Newmont Mining, you get a 4% dividend. You get 0.5% a month on a covered call, basic position. It's 10% a year that your gold position yields. Now, here's your risk. I have this bar, and I have it. And the risk is theft and loss. That's kind of I could lose it, theft and loss.
Yeah.
Right?
Somebody
So,
can steal it.
I could
This is random story.
Yeah,
but
honey, where'd that gold bar
No,
go?
my
we were playing with it the other day in the past.
my
We're
wife's
missing
uncle,
some.
he was a big gold and silver bug. He lived up in Alaska. He buried a whole bunch of silver and then passed
Then
away.
he passed away.
And nobody
you
knows
don't know
where
where
it
it is. Yeah. So, same with my grandpa. He had one heavier than this. He had a button, and what I mean by a button is usually when you take the ore and you refine it, you smelt it down, it sinks. And silver, you put it in a mold and it'll come in a nice triangular bar. I mean, there's enough there that you can get it. Golds were done in like little ceramic, kind of like pottery, and you bust them open and there'd be a little tiny little so scarce button that he would add to that button, and it was like this freaking big, man. It's like like a gold medal but thicker. It would probably be worth about $40,000 or more today. And he'd pull it out, and then he passed away. And I asked him, whatever happened to it? Because there was no cash deposit. We have no idea where it went. But in any event, if you have this in your hand, its risk is theft or loss. I lose track of it, or it's stolen. But see, the risk is higher with the mine, because they could, we don't have any more gold, or we had this industrial accident, or there's higher reward in the mine, but there's probably also higher
business risk, business reward, right?
Yeah, businesses fail.
Yeah, businesses fail.
Gold doesn't. Can't be destroyed. A business can be destroyed.
But business, I mean, that's why Warren Buffett loves them, because they're, again, that leverage aspect of it. If you have a good business, so take something that has nothing to do with gold, Apple. Who owns Apple? When we say Apple makes a ton of money, well, it's just a company, and it's all the shareholders that make the money. So every time you go out and buy a cell phone, well, each of those shareholders make a little bit off of that, right? And so who owns the mine? Well, it's all the people that own Barrick Gold or Newmont Mining. They're the mine owners. They'll get the downside in that their stock can go down, but they'll get the upside too. And that's that business risk. And so the nice thing about owning gold through a business, though, is like you talked about, you could do something where you're generating 10% pretty conservatively. 4% dividend, let's say 6% in the options. And at that rate, you're doubling what you can get in a quote unquote risk-free treasury, right? So you're doubling the cash flow. Now your only risk is that stock price going down. If it stays stable, you're still generating more than you could in cash and cash equivalents, or if that stock price goes up. And so it's really a question of your opinion on gold. If your opinion on gold is that it's going to be stable, it's going to retain its value and continue to go up, that could be a better way to play it than just owning the metal. And it's not one or the other. Let me ask you a question. What if Bitcoin never existed? Where do you think gold would be trading?
Boy, that's a great question, because it has stolen some of that.
Oh, for sure, it's stolen some of the demand some of the absolutely. I don't know if stolen is the right word, but it certainly diverted the attention of a lot of people.
You think it'd be 5,000 an ounce, 4,000 an ounce?
You'll hear people saying it's digital gold. I don't know if that's true. I don't know
what the price would be, Corey, but I'll tell you
higher.
And the irony of it just slays me, because the people that just, like, I'm a gold bug, right? I'm talking about my own tribe. But sometimes, you ever look at your own tribe and say, hey, tribe.
Don't be so dogmatic.
Yeah, exactly. Hey, tribe.
We're getting a little out of control here, tribe. Let's pull it in.
But I want to say, all right, because
it's a good way to get yourself kicked out of the tribe.
I'm not trying to say, like, everyone's so black and white. You're either a gold guy or not. You're the Bitcoin guy or not. I'm saying, whoa, wait. Let's just learn.
Yeah.
Let's just get educated. The idea that it's always existed, you can't create it, you can't destroy it. Tell you what, to go from that to supporting something that you can't touch and I like real estate, I can touch it and feel it. I like gold, I can touch it, feel it. Whew. Talk about ethereal fluids rolling around. And here's the other thing: gold doesn't need to be maintained. It takes no electricity to keep this maintained.
Yeah.
And there's overhead to Bitcoin.
There's a negative cost basis for that type of currency.
Yeah,
because it takes a lot of computing power
to verify that ledger as it grows. So it is that's a fascinating question, is where would gold be? Because you figure, what's the market cap of Bitcoin?
Yeah, I mean,
I don't know what it is.
It's billions. I'm not sure what the exact number is, but
I think it puts a dent if we say that it's the gold guys. And yet, if you're in Argentina,
well, yeah, there are countries that have adopted Bitcoin as their currency.
El Salvador, right?
El Salvador has,
Mm-hmm.
I mean, and so you got volatility, and then there's volatility, and then there's volatility.
Yeah.
So it's an interesting time. So what do you learn from all this discussion? I mean, what do you take from
I think gold has utility in the value store, but I think it's more a hedge against crisis. Mm-hmm. That's what I think it is. It's a hedge against that collapse of the currency risk.
I think a less sophisticated investor says the way a less sophisticated investor's mind operates. And maybe I just resonate with that for a reason. maybe birds of a feather flock together on that one. But in the early days, when I used to think about making money, it was just tell me what's going up. Tell me what's going up. And the nuance of being able to separate a cash flow investment to where I can have real estate that goes down and still cash flow. I can have stocks that go down and still dividend, right? I can have a business that's not even for sale, that doesn't even have a price on it, that doesn't have any capital gain fluctuation at all because it's not for sale, and get revenue. And so you have that. Then you segregate that from my capital gain opportunities. Oh, stock price, real estate flippers, gold buyers and sellers. And then you have your hedge. And in your blueprint for wealth, finding that balance that works for you and your goals is a big deal. For example, someone will laud physical gold. I can touch it, feel it, drop it on the desk, it's heavy. But I can also, then that person feels, well, I have to decry paper gold. I have to say, well, the GLD, just manipulate, blah, blah. Look, not every month, but very often I will sell puts on the GLD.
Oh, yeah.
Because that takes my currency, it's better than a bank account. And so the currency that I hold in a bank account might get 4 or 5% in the CD nowadays. Used to get 0.00005%, 2-3 years ago. So now I can get paid to buy gold cheap, and if I decide to buy gold cheap, I can convert that paper to physical anytime. I've never been paid to buy a physical. I've been paid a ton of times to buy the paper.
I found a loophole on that. For a lot of years, I would sell options on the SLV, and I would take the income and the premium and go purchase the physical.
Yeah.
But it was, again, understanding the SLV was a derivative, and I just do the wealth. We'll sell the put. Oh, if you got assigned, you own it, then you sell the call.
Yeah.
But you just try to keep the cash coming in, and then taking that money and diverting it into acquisition of physical.
So right now, to me, we'd have to look what the premiums are in GLD, but that could be attractive if we see some volatility in it. And I'll tell you, why are we seeing this fundamentally? In other words, can we correlate between this cup and handle pattern, seeing it hit its head against 2000? Well, it might be another podcast, but you have a credit rating in the United States that says, well, there's risk in it now. It's not risk-free. A double A denotes risk more than triple A, more risk in double A than triple A. And so now we have the very thing that is considered risk-free to have some risk in it. You have the deficit growing. You have the debt ceiling pushed higher. All the reasons for that. Gold could be an attractive asset because unlike 08, 09, 10, and 11, we do have inflation.
Yeah.
And then you also have the competition of the BRICS, and you also have the notion of there are many in the world that want to dethrone the dollar as the U.S. Reserve. So there's a lot of fundamental reasons that the gold bugs might be wanting to get some more of this stuff.
Yeah.
Rumor is, you got Putin supposedly buying tons of gold, thinking about maybe doing there's rumors about a currency that might be backed by gold again. Yeah. Which might affect the dollar.
And I think gold helps to be able to hold your other assets, knowing that if there is turmoil in the world and my stocks go down for a period of time, gold and silver and these things tend to do well. And that's the idea behind a hedge in many cases, is to allow you to stay in something and to weather that storm because you're making some money somewhere else. And when I look at it in terms of gold and its opportunity, what you absolutely don't want to be is the person that finally piles in after it's just absolutely going through the roof, right? You don't want to be the person that sees the neighbor making money and then, greed gland kicks in and you go chasing into this. So don't be the guy that's finally buying into gold and silver and loading up in 2011. Instead, make a plan. And that's what we talk about your blueprint is make a plan. What percentage of my assets do I want to have in gold and silver, and start to allocate some capital towards that? It's probably, for me, it's not a massive percentage. My hedges are going to be smaller percentage wise, but I'm going to still allocate some of my capital to that. I think it's an important part of my blueprint, but I don't want ever to be the guy that's chasing this latest fad, this latest asset. It's like the tulip bubble, right?
Well, speaking of the tulip bubble, did you know that Sir Isaac Newton lost his assets in that crash?
No.
He did. He got out. He made a bunch of money in the early stages of the tulip. He got out, and then his greed gland kicked in as it kept running. He got in close to the top again, and then caught the top and lost a bunch of money.
As it often happens, this conversation just set up 2 other podcasts.
That's the problem when we talk.
I want to talk about a Burry.
Oh, Michael Burry,
When you said Newton,
clearly a very brilliant mind got seduced by the price action.
So you see someone like Isaac Newton, you think, well, I got to do this, and it would have been bad advice. So we'll talk about that. You got 10. This is the question Robert hates, and I hate it too. So I'll ask it to you guys. All right, I throw $20,000 at you. Here's $20,000. You can buy one of these. You can sell puts on GLD, or you can buy Newmont Mining, or you could do a fancy derivative trade on Newmont Mining, like maybe a leap with a covered right, or do you just say I'm going to go tech and AI and go somewhere else?
Well, my first would be to find the best stock available. So whether that's in gold or somewhere else, that's my niche. That would be my first, circle of competency for me, is I know I can make money there. And the way that I would do that would be in cash flowing positions.
Newmont Mining, 4%.
Yeah, Newmont Mining would be something to consider. And I like it from an investing standpoint when it's not the latest craze. So like I said, gold's holding up relatively well, even though the U.S. dollar's done pretty well. If you look at a longer term chart, the U.S. dollar's done pretty well, and gold's still up there near the highs. If we look at interest rates have gone up a ton, that typically hurts gold, yet gold is up there near the highs. You look at Bitcoin and some of these other things that have stolen away some of the luster, and yet gold is up there near the highs. So those are market tells, if you will. That's something that it's holding in there pretty well, and I'd want to own it now. And then if I was going to sell, I would sell in the craze, not be buying in the craze.
The confidence in gold has kept it high because despite all those factors you just met, every time it's dripped back down, our cup and handle, it drips back down. People have been battling to keep it up. Yeah. But on the other side of it, they haven't been able to say, well, I'm going to pay $2,100 an ounce for it.
Hasn't reached that next level.
You got $20,000.
I'm going to Vegas.
All right.
I'm going to bet on black.
I mean red.
Double zero green and make your big bucks.
That's a great question. I'd probably follow the same line of logic as Corey. Go find an asset that produces income. There's quite a few I've had my eye on right now, just doing the evaluations of it. I do like something. I look for 2 things. I like the dividend, and I got to have options so I can control risk and generate income. I feel most comfortable and confident in that arena. So that's where I'd go.
I'm smarter than both of you guys for the first time. First time in history.
You're not going to Vegas with me?
Oh no! First thing I do, if I get $20,000 fall in my lap, I buy my wife a present. That's happy wife, happy life.
I blew that question.
Yeah, you guys, your wife's going to hear this, and they're going to say, Andy gave you 20 grand. You didn't even think of me.
Yeah.
See, you didn't even think of me. See.
Well, see,
Well,
I
she
was
was going
gonna
to Vegas with me.
See, I was going to compound the money so I can buy her more stuff. That's the point.
Yeah, that's what Buffett tried to sell his first wife.
Yeah.
How did that go? She moved to San Francisco.
He made billions and
Yeah.
she left him. So
Yeah, she
there
went,
you go.
she went and said, hey, we got to be spending more of this money. She
Yeah,
went to
right.
San Francisco, right? Oh, great discussion. So that's a little bit on gold. I could talk about it all day long. Hope you gained something from the discussion. I want to thank Corey, Noah, always. This new little regimen we've got here of getting together has just been delightful. So
Very fun.
a lot of fun. So we thank you for watching and listening. Those of you that want to see those charts, catch the video on YouTube. And you've been listening to the Cashflow Academy podcast show / production.
Yeah.
We'll see you next time.